Welcome back to Markets Today. I'm hosting Joseph Kahinda from Standard Investment Bank, and we're having a conversation about investing in Europe and the sectors that he had mentioned where there is opportunity include energy, fast-moving commodity goods, especially renewable energy came out strong as a sector that you should have a look at. And we are continuing the conversation, Joseph. But this time around, I want us to bring it down to the three major markets, the UK market, the German market, and the French market. Now, the UK economy is facing some major challenges. I hear there is high rates of inflation, and there's also the high rate of labor shortages being experienced across the country. Are these symptoms of a poorly managed Brexit?
Okay. So allow me to break that down into two. So I'll start with the inflation, then move into the labor shortages. So on the inflation, with regards to British inflation, I do not think it is a Brexit
problem
side effect per se. The reason I say this is, so I look at it from 2016 to date. The trend of UK inflation. So we had it start rising in 2016, that is immediately after the vote. It rose to highs of about 3% in 2017, then started ticking back downwards, right? Came back down to around 1.3 by end of 2019, right? So essentially, I would say the Brexit effect on inflation sort of evened out. Coming into 2020, now that's where you have your pandemic hit, and what you're seeing in Britain is the same pattern you're seeing in Europe, in the States, in most developing countries, where during the pandemic there were a lot of monetary stimulus measures that were pumped into the economy. And with all this money, you have pressures on prices, you have pressures on supply, you have pressures on spending, which in aggregate led to extremely high inflation numbers, right? So the high inflation is, I would dissociate that from Brexit,
but associated with COVID-19.
Associated with the pandemic. Which, again, we've just talked about, right? So they've already started hiking rates, 25 basis points. That's 0.25% last week. So they are actively looking to arrest these developments around inflation.
Yeah.
With regards to the labor, as a function of Brexit, I would say yes, there is some relation there. So what happened is after Brexit, markedly in 2019, when there was a vote and it was agreed that this is going to happen, because all along after the vote in 2016, people still did not believe it was going to happen, because this is, but then when it was finally processed that it would happen, and people accepted that this is happening, we saw changes or shifts in labor movement between the EEA, the European Economic Area, and the UK. I think the most affected sector is healthcare, right? So there used to be a lot of health professionals moving in from the European Economic Area into the UK. This number dropped by up to around 90% in 2019 alone, right? So to answer your question, yes, Brexit has had an effect on labor movement into the UK, and how the UK is looking to address this is they are currently coming up with a skilled migrant program to attract skilled labor into the UK.
Do they have a target market? where they are going to get these skilled professionals from?
So from my understanding, it was basically from the European area to begin with. So they arrested, because initially it was just free movement of labor, capital, goods.
Naturally,
everything.
They were part of the Eurozone.
Yes. But then one of the concerns that the pro-Brexiteers had was that a lot of the people coming in from Europe are coming in to benefit from the UK social welfare, which was probably a bit more generous than in some parts of Europe. So they want to limit immigration to skilled labor that will benefit them. Programs are like what you have in Canada, Australia. I don't know if they'll be similar because they have not yet made any white paper on
No,
that I know of on the same. But we would imagine, because they said a lot when they were negotiating Brexit, a lot of the policies that they said they want to implement are basically the CANS policies, Canada, Australia, New Zealand policies, which have targeted labor policies to skilled migrants. So that's probably what they want to do.
Yeah. There was a notion that they'll probably target the Commonwealth countries, former colonies of Her Majesty's government, for skilled labor.
So the thing with that is they might want to do that, and if the EU labor is not forthcoming, that will be their next step. That may be their next step. Yeah. The only thing about that is a lot of times, a lot of the Commonwealth countries, first of all, are not as developed as the UK. Save for your Canadas, Australia's, New Zealand's, which
but they have skilled labor. I mean, I saw here they came for our nurses, except our nurses were speaking English with an accent.
Now, the thing with that is a lot of the industries within the UK that they'd want to import labor from currently require immigrants to retrain.
Oh.
Yes. They require immigrants to retrain because they do not recognize degrees from some parts of the world. And this is not unique to the UK, actually, though.
I know. It's just, it's hurting.
I know, you study for all those many years.
Correct. And someone wants to retrain you, and probably the person retraining you has 6 years experience while you have 14. It hurts. But anyway, how has this twin problem, if I can call them that, the high inflation rate and the labor shortage, affected the stock market performance? I know we had mentioned that they really outdid themselves last year. Is it that they have shrugged off some of these effects?
So we've talked about inflation and labor. I'd just like to mention that Brexit also had other unintended consequences around, say, things that affect the economy, around academia, for instance, which determines the quality of output that you have as a country, because it determines the level of training of your working population. It also affected trade routes, right? So because of trade, this has some negative effects on the UK economy. Generally, the consensus by economists is Brexit will have a negative effect on the UK. And this will happen through reduced per capita incomes, right? Now, to answer your question on the effect it has had on markets, first of all, looking at it on a purely market perspective, the economy has recovered, right? It is way above where it was pre-Brexit levels, the FTSE 100. Markets have recovered.
When you say pre-Brexit, you mean 2018?
2016, before the vote in 2016.
Oh, before the vote in 2016.
Yes.
Okay.
Because, after the vote, then markets started pricing in
that
moving,
reality.
as much as people, a large number of people didn't think it would actually happen. We saw a huge move in the markets 2016, then it corrected a bit. So markets have corrected from Brexit in general. However, the economy itself, we cannot say for sure the impact that it has had yet, but we've seen large companies move their headquarters from the UK, London, into EU countries. Major beneficiaries have been, say, Amsterdam, Paris, a lot of countries have companies.
Which companies are these?
So for instance, banks, some banks have moved, the European Bank itself as well, and also manufacturing companies as well. So you have a lot of exits, Brexits in themselves, exiting Britain into the EU.
So this Brexit is in the other direction.
Oh yeah, it's happening in the other direction.
Yeah.
So what you had initially was, or rather as a side effect, initially capital was flowing because there were no borders from the EU to the UK, right?
Yeah.
But now what has happened, or what we've seen happening after Brexit, is a lot of the companies that had gone to the UK and capital that had moved to the UK, or that the EU was sending to the UK, has come back to Europe. And labor that was going into the UK.
Yeah, so that means the economy is significantly affected, even though you say the measure can't be ascertained, but it is affected. Because if capital is flying, it means there is no investment. And no investment means no jobs. And no jobs means no savings. And no savings means no further investment.
So that is one way to look at it. What I like to do is look at the actual numbers, right? And while the impact hasn't started showing solidly in the actual numbers, I do expect that with time, because some of these things are very slow to manifest, to happen, right? It takes a very long time for you to see the impact. Some of these things
on a long term.
It transmits into the actual bottom line of a country's balance sheet.
Okay.
Right? So we do expect it will show, however.
Which stocks capture your attention at the London Stock Exchange?
Okay, so with the FTSE, as it would, I would particularly, again, the sectors that we've mentioned that are rallying regardless of where you are in the world, energy, right? I would really be happy to look at BP. In fact, they released their earnings earlier this week, and they topped estimates and beat. They had the best results for the last 8 years. The stock is up quite a bit. That's an interesting one to watch. I do expect that they'll continue to overperform as oil prices and energy prices in general continue to rise. Other counters of interest would be within the financial sector, banks, insurance companies. Those remain my
Any specific bank that has captured your attention?
I would it's a bit discretionary on that one, for purposes of.
I was hoping you'd tell me as Joseph, not necessarily as SIB, but I'll yield. Let's go to the Germans. The German stock market is also one of the largest in Europe. I think it's is it the third or second after the London stock market?
It is actually after London. It's the
largest. The second, yeah. All right, but there's been reports of high price volatility. What explains the volatility?
Reports of volatility. Okay, so with the German stock exchange, so the index that tracks the German stock exchange is the DAX index, right? I can't say it in full because it's a German name, and my German ends at Nextalt.
Yeah.
So with regards to volatility, we actually did look at this a while back at the fund, and the DAX is not that much more volatile
than the other
than say your FTSE, your S&P, your CAC, which is the French index. They are all, over a period of a week, they all exhibit about between 1.5 and 1.6% volatility.
So you've denied volatility, fair enough. But
however, it is volatile in nominal terms. I would attribute this to the composition, one, of the exchange, and two, so volatility is driven by two things, right? What is being traded and who is trading. So the composition comprises the what? Composition of the DAX exchange, DAX index, you'll see 20%. So the top 20% of the index is purely technology stocks. And then the next heaviest component is financials. Then after that, you have your health technology, which is still technology. And then after that, you have your still another form of technology.
So it's highly susceptible to factors that are driving technology up and down.
So you see, in a whole, technology actually makes up 40% plus.
Of
so
the
that's
German market.
The technology, health technology, and the fourth technology, right? Which is, I had it somewhere. I'm just trying to remember off the top of my head.
I'm trying to push you because I have less than 3 minutes.
Oh, fantastic. So technology, financials, electric technology, and then health. 40%. With technology companies, what we say is they tend to be extremely volatile. The Nasdaq, for instance, volatility over a week, 2.5. And why is this? Because you've had a lot of movements on long-term interest rates. And technology companies are valued very heavily on earnings projected very many years ahead. So when you discount these earnings, they are very sensitive to the smallest movements in long-term interest rates, which is what happens in Germany. That's why it seems very volatile.
Yeah. Briefly, is there perhaps any effect that the Ukraine problem has had on the German market? And I've chosen the German market because I know they are more susceptible to Eastern Europe.
Okay, so currently there are talks between France, Russia, Ukraine, and Germany. So Europe is trying to really champion an amicable solution between the two, Russia and Ukraine. Why is this the case? This is because a lot of Europe's energy actually comes from Russia. Their natural gas sources, northwards of 60, 70, 80% comes from Russia.
Yeah.
So basically, what you have here is a situation where, well, you have one developed country saying that we will attack
Ukraine.
No. France, Germany are saying we have to negotiate because for them, they know this is where our energy comes from. We have to protect our interests as a bloc.
Yeah.
So
have the jitters been felt in the market?
So yes, over the last few weeks, we've seen natural gas prices go up quite a bit, northwards of, not even just natural gas actually, even oil prices, right? And we saw a bit of a retracement this week when the French president, Macron, said that Russia has given assurances that it will not invade Ukraine, right? That was last week actually, last week to this week.
Looks like we are going to end the conversation with Germany.
It was so good.
But I want to perhaps make sense of the hawkish stance by the European Central Bank, which you had mentioned, that Christine Lagarde came out and said they are considering reviewing the rates. Are there significant effects, especially in the markets? Is this reflecting in the market, in the stock markets?
It has reflected. We have seen, say, for instance, the euro gain northwards of 2% against the dollar over the last 2 weeks, right? The euro technically has been on a downward trend against the dollar since 2008, right? It has been losing ground against the dollar from 1.5 to below almost parity. Now, what we have over the last week after Madame Lagarde's comments, a strong bounce from 110 levels around to 114. People are pricing in rate hikes. She tilted hawkish because for a very long time, Europe has been very accommodative.
Yeah.
You have your German bonds were below 0% since 2019. Today, as of today morning, they're above 0.2%. That's an increase of 0.3. You know, it will be remiss of me to say what effect it would have on the markets going forward, but to be honest, markets are pricing in a move.
Yeah.
Markets are pricing in a move.
All right, I think we have to call it a day. Perhaps next time we'll have a time to talk about the French market.
In French.
Français.
Oui.
Yeah. But thank you very much for coming, and give our regards to your colleagues at SIB.
Thank you for having me.
This has been Markets Today, and we are having a look at the European investment market and what is available for you and I, and what are the risks that are there if we were to invest in Europe. We have learned that there are significant areas of interest, whether in the financial sector, fast-moving commodity goods, or energy. And whether it is in Germany or in the UK, I think there are opportunities. Brexit has waned over in terms of having its influence or impact being felt at the London Stock Exchange. However, there is still a little impact here and there. On the other hand, COVID-19 pandemic has also had its day, its field day, but the markets are recovering. We have seen 20% performance of the FTSE 100 in 2021. In other words, if you put in 1 million shillings in January of 2021, January 1st, by the end of it, you'll probably have 1.2 million shillings to talk about. I'm really hoping that the currency would change to pounds, because that would be quite something. I've been your host, Odhiambo Ramogi. This is Markets Today, and we have come to an end of our show today. Join us again tomorrow as we talk about pensions from 4 p.m. all the way to 5 p.m. Goodbye. I'll leave you with the currencies of the day reflecting on your screen. Have a lovely evening.